It adds reputational risk. It adds compliance risk. It adds regulatory risk.
Hello, everyone. Welcome to Housing Insiders, the podcast for founders, builders, lenders, and regulators, and anyone who believes that everyone should be well housed. I'm Jonathan Wallace.
And I'm Jeremy Potter. On Housing Insiders, we're bringing you the smart conversations with people in the know, combined with those actionable ideas that you won't hear anywhere else.
And because last month was home ownership month, Jeremy and I have made a call that July will henceforth be known as Mortgage Month, or at least it will be known as Mortgage Month here at Housing Insiders. So we're going to try to dedicate the next 2 episodes in the month of July to conversations with top thinkers and leaders in the mortgage world. And, you know, things are happening with rates. Maybe rates are going to go up. Maybe they're going to go down. There's always all sorts of things happening in my hometown of Washington, D.C. So we think that these episodes couldn't be more timely.
Yeah, I mean, as you lead into the dog days of summer, what is a better topic than the optimism of mortgage? I think a lot of people think of it as one of the most optimistic. Wait, we'll find out. And we'll find out from today's guest. So we are lucky today to be talking to Justin Messer, the president and CEO of Prosperity Home Mortgage. If you don't know, Prosperity is a full service mortgage banker. So we're talking residential loans for purchase, refi. And we're going to talk a lot today about where both of those channels go. We know that the purchase business is a huge part of what Prosperity does. And the reason is they're associated with the Berkshire Hathaway family of companies. And so we're going to definitely ask about that. Justin's based in Virginia. There's 500 branches nationwide. And of course, they're a nationwide lender. So Justin, thanks for joining us. We're really excited for today's episode.
You got it. I'm happy that I'm DC proximate as well. Like I can at least hear about policy stuff, even if I'm not actually involved in it, right? Close enough.
Definitely close enough.
We should tell people you got the connection. You're DC proximate now. You, I think, learned a lot about the mortgage business in Michigan. You still spend some time in Michigan. So we have the double connection here on Housing Insiders, DC adjacent and Michigan.
I think that's why I got the invite, right? Checking all the boxes. So
you got to check Ohio to really check all the boxes.
Well, I mean, it checks a box for me. It's just not a good box.
Here, here.
Justin, why don't we start there? Give us a little bit of your background and journey, because I think you have a lot of really interesting experience that leads you to where you are today.
I'm a lifer, so came right out of college, and first job out of college was with Quicken. Obviously now Rocket. So I started there in cap markets. Came up through the ranks there, and then 15 years ago was kind of offered an opportunity to build a real estate affiliate mortgage company. At that point, it was a kind of mid-Atlantic centric realtor called Long and Foster. They had a joint venture with Wells Fargo. I was brought on to kind of build the back office and the infrastructure to leave that joint venture and make it wholly owned. So cool opportunity. And what a switch from refi centric. I mean, I think at that point at Rocket, we were probably 97% refi or something. If a purchase happened, it was an accident. It was a friend and family. We probably did terrible on it. I have no idea, right? But to switch to that from that to at that, back when we started this, when we left the joint venture, my guess would be we'd be 97% purchase. So a complete flip of the scale, different pipeline management, different customer interaction, multiple customers in the transaction, just a completely wild thing. So, while I still hold on to a lot of my core of where I started, in refi centric, which adds just a whole different set of values to what you do, but I obviously was able to, thankfully marry that to the purchase centric idea as we move forward. And now we're trying to kind of blend them all together into one symbiotic experience for folks. I think like everyone's trying to do. So that's kind of my background. Again, capital markets person, who kind of made my way around and kind of traipsed my way to CEO now of Prosperity.
Yeah, one of the things that we see a lot of is, especially in the mortgage industry, it's like banks and independent mortgage bankers are almost like a Venn diagram with quite a bit of overlap, but not entirely the same. And you have a ton of experience in those models, and particularly in the independent mortgage bank model, which is so sales and marketing focused, but so dependent on the capital markets. Can you just talk about a little bit rising up through the capital markets, having that experience, but leading a sales and marketing organization as well, and what that balance looks like for you?
Yeah, I mean, that's fantastic. I mean, when you think of capital markets, one of the big pieces there is just risk, and risk management was a key part. It's interest rate risk, but it's also counterparty risk, it's compliance risk, it's legal risk. It's a lot of that mentality, and you have to I don't know if it's harden or soften your skin, one of the two, when you move into more of a sales-centric organization. But I think the great thing is as you move through it, you realize that everything you've done your entire career, regardless of where you are, has some aspect of sales to it. And I've said this before, but one of the best pieces of advice I ever got was I was hedging interest rate risk and I was watching it, and loan officers were being loan officers, taking extraordinary advantage of us when the I don't remember if the market was rallying and they weren't locking, or whether it was falling and they were locking, one or the other. And I was getting really really frustrated, and a guy who'd been around a long long time looked at me and he said, "Justin, relax, no loans, no jobs." Right. And at that point, it's very very important to remember that if you're going to be in this industry, especially in retail, like the loans are what provides our income and our livelihood and our jobs. We could be the best executors and the best risk managers in the world, and if we have no raw, inputs, it doesn't matter, right? So you have to kind of, I would say, balance. It's such a big balancing act. I think being a sales organization, you really can let it run wild if you don't think about putting guardrails around it. I think is the biggest thing, and banks have traditionally a much better posture and culture around that. A lot of that is because if you're joining a bank, you know what you're getting. In addition, they just don't, they don't allow you to wander much. Independent mortgage banks, part of the problem is we all compete with each other for the same talent, for the same kind of distributed retail in our case, loan officers, and so that's where you can kind of go to the least common denominator at times, which someone is willing to do something, someone's willing to do this, someone's willing to provide this, someone's willing to do that. I saw a great like cartoon yesterday. Actually, a guy presented it, and it was a parent and their child, and they're sitting there, and the child said, "Hey, I know it's been a rough year, and we're watching our budget, but I just wanted to let you know that the Smith family has offered to." Include Disney World in my annual package, and I will be leaving and joining the Smith family. And that's like a great example of it's perfect. And that's with realtors, right? That's with all sales organizations, right? But that's kind of the thing, which is you're constantly trying to provide a true value to someone. You're trying to give a case for why you're there, a differentiator, and something like that. And fortunately for marketing, we do have the ability to kind of ride along with our real estate affiliate, and they do a lot of the sphere marketing for us and things like that. So we're able to really really just invest in the process and the customer process, and focusing on kind of the experience for folks.
Yeah, for people that don't know Prosperity, can you talk a little bit about those affiliates and how that relationship works? Because I always think of, different mortgage banks are always going to have a different creative strategy that they use to like find people where they are, right? And that might be Super Bowl ads, it might be something else, but the affiliate seems like a big channel for you guys. Can you talk a little bit about how that works for Prosperity? What percentage of your leads are generated through those types of relationships?
Yeah, so right now we're sitting at about 61% of our purchase comes from our affiliate relationships. So that is, and we say affiliate, like we're wholly owned by the same company. So our parent company is called Home Services of America. It's about 40,000 real estate agents. That doesn't include our franchise business, right? Throughout the country. So it's owned brands. So it's what I call like private label brands throughout the country, still like a Long and Foster or a Reese Nichols in Kansas City, or an Ebby Halliday in Dallas, so large brands, and then also wholly owned brands like BHHS something, and that stands for Berkshire Hathaway Home Services. So a Fox and Roach in Philadelphia, or a BHS Georgia Properties in Georgia, are franchises, but they're owned by us, which is kind of a unique little spin on things. So that equates again to a big percentage of our business. We have distributed retail loan officers, not necessarily on an office by office basis. We tend to focus more on, although we have that, and that is a core thing of ours, we have a tendency to focus on loan officer to agent relationship, right? So it's kind of like the old model was you took a loan officer who was really really good at building relationships with realtors and very transactional, not very sales oriented. You kind of throw that person into an office and you say, have at it, go get 20% of these deals, get one out of five. In reality, when you look at that model, which is the old traditional affiliate model, can you really expect one person to work the same way, mesh, et cetera, with 100 disparate styles and personalities in an office? The answer is no. right? So instead, we're more into a matchmaking mode where we say, hey, we have 500 loan officers throughout the country in an individual market. We'll have 20, 30, 40, 50 loan officers that represent every, every personality, every race, every gender under the sun, that we can match people together with people that, they want to work with, so that they don't feel like, hey, we're pigeonholing them into, if you don't really fit with Justin Messer, I'm sorry, you can't do business with Prosperity, right? So that affiliate model is, again, we're in office most of the time. We have access to sales meetings and things like that, which are positive. We certainly have the option. It's certainly easier for us to set a coffee appointment than with an outside loan officer. That's kind of where the advantages stop for the most part. Like, we're not entitled to business. Nobody provides us business on a silver platter. We have to win business, and not only do we have to win it from the agent for the referral, but it's not like that referral comes with like a built-in conversion rate that is high. People are still shopping. They're still hunting, and generally, a lot of realtors, especially when it's an affiliate lender. So in other words, this is in my office, they know that their reputation is on the line there, and they never want to feel like they're steering anybody or doing anything, even though that's not a thing, right? So generally, they'll put us in competition almost every single time, which is a blessing and a curse. It keeps us sharp, but it also makes it difficult to have very few deals out of comp in general. So although from the outside it seems like it should be a pretty easy model, and listen, we're blessed for what we have, but it does create a lot of competition when we're going to market.
Man, that raises so many questions for me because I've always thought the role of the CEO as the leader, balancing all the different stakeholders, investor owners, homeowners, home buyers, team members, referral partners, whether they're affiliates or not, you're constantly having to think through the 360 degrees of that decision or that implementation or that investment, whatever spending is going to happen. Do you have somebody you think of as the customer? Is it your sales force? Is it your investor? Is it the homeowner? How do you think about it, and how would you recommend the mortgage industry think about it?
Well, for us, it's pretty simple. I mean, for me, I think you always stand on the shoulders of the person below you in the transaction, and that is your customer, right? So that's how you have to think about it. Me being at the top, everybody's essentially my customer, and I have to try to balance it and rank those privately, decision by decision, about who's the most important. And I won't break any news here about that. But what I would say is, I think reframing it, our sales force generally all comes from distributed retail, purchase driven, right? So they already have the mentality that they have a couple customers in every transaction. One is the buyer or borrower, right? But secondarily is definitely that realtor, and that realtor's reputation, is kind of what they're protecting, right? So we always say that the realtor's reputation and your referral source in the future is what you're protecting on this transaction. And that's something that was really, really difficult, especially, I'd say when COVID happened and we expanded beyond our traditional operations back office force to folks who hadn't been kind of in our model for 10 years or 12 years. That concept doesn't really, it's always the loan officer is fighting for the deal and for the exception and for the pricing to get paid on that individual transaction, is what generally the back office thinks, right? To try to retrain folks to understand that it's not necessarily about that transaction, but it's about the future string of transactions. By making this transaction delightful and special is something different. I mean, I think when I came up in the business in more of a refinance centric shop, it's kind of a conveyor belt, right? So a deal falls off, the spillage and the what can happen from that, the contamination is very limited, right? It's maybe limited to that person's sphere. Now maybe you can jump on, a consumer website and really, go off on X or something, and it could be bad. But back then it wasn't even really that. It was pretty narrow. In a real estate transaction, the stakes are so much higher from a mortgage perspective, right? Because if that goes poorly, and if you think about our model, if I have a $1 billion real estate office, I don't always know who's on the other side of this transaction. My processor, my underwriter, my client care team, they don't necessarily know this. It could be a very vocal agent in that office who's very well respected. If a deal goes material sideways because of a mistake that we make, you're not just impacting that deal. right? They're going to stand up at a sales meeting and talk about how terrible the experience was and what Prosperity didn't do, how they didn't stand up, how they didn't show up when they needed to show up the most, how they didn't move mountains, how they aren't customer centric. Even though you could have 50 great transactions with that realtor before, it's the one that defines you. And that's kind of what you live with. So what we did is we redefined for our operations and back office team the customer. We defined it very specifically, right? So we said, all right, number one, you certainly have the buyer or the borrower, right? They have to be centric on the transaction. You have to make sure that you're doing the best for them, acting in their best interest, and giving them a delightful experience. The second person is the real estate professional. And you have to understand that the real estate professional needs to be updated transparently. Surprises are an enemy. Bad news early is good news. Okay. And then the third person is your mortgage consultant, as we call them, or loan officer. So, Jeremy, to your point, you still have to build that relationship as if that's the customer. And again, it goes back to no loans, no jobs. Okay. And I think, a little bit of that empathy of living in that person's shoes, understanding that they need to walk into that real estate office tomorrow. They have to deal with the repercussions of this transaction and that it could taint their entire referral source and livelihood. It's almost nerve wracking the stakes that creates in an individual transaction, right? But when it just becomes second nature, everyone kind of starts to pick it up and really operate under the same language, so to speak, as we're moving it forward.
So Justin, I think at some point when I was at Fannie Mae, I was yelling at you about prepay speeds at Quicken, maybe or something along those lines. But I, like you, my background is like very, very secondary market, very behind the scenes, and now I actually find myself in my current role, like sort of being more front of the market. It's actually been quite interesting, and I was looking at a couple of programs that you offer. I was kind of curious to get your perspectives. One of the things I found really challenging, especially if you're way up in the transaction, right? You've got a realtor who's bringing you a client; they're just starting to look for a home. It's like, how do you pre-qual? How do you give that customer some comfort that they're working with somebody that they want to stay with, that they have some comfort that they're going to be able to close? And it seems like you guys have gotten creative around that. And I saw something Competitive Edge, maybe a couple other products that you've offered to kind of help in that sort of pre-qual process. But I'd love to get your views on.
Yeah. So, yeah, one crazy thing, that we certainly learned that I think I didn't really understand is generally good, or I would say more seasoned real estate professionals. They don't really work with a customer and they're not going to dedicate their time, which they're rightfully selfish with, to someone who isn't long term going to qualify for financing, right? And they want to make sure they're looking at the appropriate priced homes, et cetera, right? And the world used to be, at least in my opinion, predicated on like really light prequels, right? So it's kind of like, hey, I talked to my loan officer who I trust. He told me this person looks solid at the 500 range. I feel okay about this. And as the world progressed and the market got to be, much more of a seller's market, yeah, sure, that might be okay because you trust your loan officer and you have that loan officer real estate agent relationship. But when you go to the offer side, the listing agent does not have that same relationship with that loan officer or the company or anything, right? So we understood that we needed to give something that gave people a lot more, let's call it like gravitas at the offer stage, but also gave them, the ability to at least be a little more flexible on financing contingencies should all things be met and things like that, right? So one thing we did is we went ahead and, we thought originally, hey, how can we make this, valuable to everyone, from a standpoint of a hard pre-qualification. We called it our time closing guarantee, and then we wanted to make it like two-side valuable. So we were like, okay, listen, we want the buyer's agent to feel confident in using us, but we also want the listing agent to feel confident in using us, right? So it's both sides should it go wrong, right? So that's how we kind of split it up, and it's a full, pre-approval underwritten, and just so like, that's a value add we think, yes to the borrower, but more so to the agents, right? To give them confidence in transacting and to move forward. We think it's a value add on both sides, right? And I think again, it's not inexpensive because unfortunately these aren't all just day one certainty push button get mortgage type loans. They do fall into that a lot of times, right? And then it's only a couple $100 for us, but the rest of them are like, these are non-QM loans. These are non-conforming jumbo loans. These are loans that cost us a couple $1,000s to get through this process, to then give the buyer something so that they can really go to the table with a really really strong offer. And again, you have to think of something to differentiate yourself in the space, and our goal has always been the same, which is when someone is looking at an offer and they get to the pre-approval side, I want them to feel happy and delighted that it says prosperity, right? And if I can do that, then I've accomplished what I want for my buyers, right? Which is giving them some kind of edge for using us in a commoditized business that is just so tough to do, right? So there you go. And then I want the listing agent, when it comes around time for the appraisal, for them to look and actually know who the appraiser is, right? To know that it's a respected person. It doesn't mean it's going to come in at value, but they know they're going to get a value that's accurate, right? So if I can hit those two things, if I can hit a quality offer, right? That's backed, and they have confidence that we've done our due diligence and this person is going to get to the table. And then if they know that the collateral is going to be solid and come in at a value that's fair and that's accurate, then we think we've done our job.
Yeah, for sure. I mean, I think when I joked earlier about optimism versus pessimism, the optimism part is always the American dream, right? Giving somebody that chance to own a home and walking them through that certainty and confidence, working with your professionals, your process, your playbook. But then on the other hand, there's the pessimism of like, we talk all the time in the industry about everything that goes wrong. Why is this still a problem? Why is this still an issue? So I don't want to take away from the optimism of what you just described, and the ability to make that promise and give people a real certainty is huge and valuable, as you said, particularly in a commoditized business. You mentioned the appraisal. You mentioned some of the other things that can come in and throw it sideways. John and I go back and forth with this all the time. What's still the thing? What's still the problem? What's still, sometimes we, fire shots at the GSE guidelines because they still seem to be way too specific and way too detailed. And you need this document from 6 years ago. And other times it's really big picture stuff like the appraisal industry and like the title industry and property related things that are outside of your control because they're third party services. Can you talk a little bit about, as you've dug in and refined and refined and refined your process, what still sticks out to you that's like giving you issues? What's still frustrating your team?
Oof. I mean, yeah, I think the agencies is always a trick, and like I would say, they're great to work with, like honestly, and they've become very customer centric, both for the borrower and for seller servicers. I'll say that, like it's been great. The problem is, yes, there's high specificity in some areas, and then a complete lack of specificity in others. So that dual identity that they have makes it very, very, very difficult. And one person's black and white is another person's judgment call in the same organization, which leads to inconsistencies. And I think that's the hardest part, which is creating consistency up and down your organization at this point when we're still very human driven in a lot of decisioning. I think that's the toughest thing, right? Because you want things to be predictable, you want things to be repeatable, you want the same decision to come down from the same credit policy organization, and it just doesn't always happen. I'd say that's the part that continues to be difficult as you try to build something at scale, and try to also, I'd say make it the most efficient, which is not like one-to-one relationships with a small sales organization and a predictable underwriter, but instead a group of underwriters where you're sharing risk and across broad groups. That's certainly a challenge. It's a challenge for borrowers. It's a challenge for loan officers as well. I think the other part that continues to kind of rack me the most is something I know it's close to your heart around affordability and condos being a huge access point for people. The difficulty with condos just continues to just really be tough, and something that I think we advocate for a tremendous amount at both Fannie and Freddie. And as long as the rules are the rules, we can debate the rules. When the rules seem to be very unknown from time to time and very gray and difficult, that's when it gets hard. Because the last thing I want to do is deny someone the ability to enter the housing market based upon a judgment call from our organization, or worse, like make a borderline judgment call and then have that building impacted and have to have them do something, right? It's like it's too much gray area and potentially too much power in the lender's hands about what the views are on condo, right? So I think from a especially from an entry level standpoint, I think condo is an area where we need to continue to work hard on. And then with appraisal and collateral, I mean, I don't know what's going to happen with the new update. You could see people flee the market. You could see this continue to be more of a problem. I think the GSEs probably need more data than less data, to continue refining their models and getting to a point where that's a little bit, less necessary. But yeah, I'd say just consistency in condos in a for a very long answer. I apologize for that.
And I
No,
figured
that's
that
a
would
good
be a long
answer. Yeah.
answer. There's a lot to talk about and a lot to think about, and I like I said, I'm sort of experiencing a lot of it firsthand as well. I think one of the positive things you didn't mention, but I'm sure is often on your list is sort of credit scores, the cost of pulling from different bureaus, so on and so forth, the introduction of Vantage. On the plus side, it's it's great that renters are finally getting their rental data counted towards their credit score. Anyway, just any thoughts or comments on what's happening with credit scores right now and how you guys are kind of managing some of the transitions?
It's just been tough to navigate. And, I'd say this, our LOS, we use a vendor, right? So we have a third party LOS, and I think one of the rushes to a Vantage is two things. Number one, like whoever your credit provider is, and then whoever your loan origination system is. Again, if you outsource that, the readiness of them versus the readiness of the lender are two very different things. So, you could drop the greatest credit score model in the history of the world to me, and if the vendor that I have, like my credit vendor that I have, or partner that I have a deep relationship with and a pricing model with, that I need to kind of be a little bit captive with them in some ways. And then my LOS, if those dually aren't ready, then I really can't take advantage of it, right? And I'm a big wait and see type person with most stuff. I don't like to be first. I don't like to be. I like to be somewhere north of the middle of the pack, right? But definitely not there. And like I don't like the wins I've seen have seemed fairly limited, but I'm sure they're out there. But I think if it were like this windfall of greatness, I think we'd be hearing more about it than the occasional one or two things. Again, I don't know enough about it. I'm not on the inside of it, right? But I think no matter what, it drove competition and it continues to drive competition. So everyone's going to level their game up and it's going to get better because whenever you have kind of a captive industry, you're not going to innovate. Why would you, right? So no matter what, it's better for the industry. Personally, though, I can't really speak to it from experience.
Yeah, I think you're I mean, when we've looked at sort of what the impact on credit scores is from rental data, it's meaningful. It's 10 points or so. That's not gonna be game changing on any small scale, but, like, when you look across millions of consumers, that's gonna move the needle. The thing that I often find frustrating and, I'm sure you feel the same way, is sort of when I look at what Fannie's doing and what Freddie's doing and then what FHA is doing, what VA is doing, what USDA and what my other investors might be doing, it starts to make things really complicated, especially since when borrowers come to get pre-qualified, they're not wearing a shirt saying I'm a conventional loan that will get, day one certainty through you know what I mean? Like you just don't know. And so like I don't like like I've got three credit scores for each of the borrowers on the loan. Like which one's going to be the representative one? Now I've got two different types of scores and FHA accepts this and Freddie doesn't and Fannie uses the lower of the two and anyway, like all of that complexity is just really infuriating when you're sort of at very especially when you're early on in the process. Like if you could do it at the end and just figure out what score you need to use, it's easy, but it's like it's such a core part of the process and a growing expense.
Yeah, and tough to avoid like a disparate impact there of, you kind of just get lucky based on did you find the right person that got you into the right program at the right time with the right deal, right? And actually had the wherewithal to dig that deep and the strategic nature to dig that deep as opposed to taking one look and going FHA right off the bat. And yeah, I mean, it seems like a complicated problem. It also seems like a rule-based problem that could be solved by, let's just call it, not that I'm going to have an LO bot at any time, right? But like some type of pricing agent up front that can take all the inputs and then figure it out. We've tried to do that repeatedly, which is based upon the situation. What is the best? Like that was our first implementation of any type of AI at Prosperity. Just like, here's my situation. What do we think the best couple options for products are? As we just started to expand, so broadly into non-QM, and a lot of non-conforming options started to drop the loan limits that they allowed pretty drastically. So it just opened up a tremendous amount of options. And when you got 25 credit union partnerships throughout the country, it just is a lot of options for people, especially when a lot of loan officers, especially in the purchase business, they're trained to do one thing, right? If it's above 620, they go conventional. If it's below 620, or maybe it's 660, right? They go FHA. Trying to get them out of that mindset has been very, very difficult, especially as FHA has become tremendously more attractive. And like there isn't that, let's call it, concept or persona that it's going to be harder for it to get accepted in an offer. Once that got off the table a little bit better, right? You start to see that there's extraordinary advantages for folks in some buckets. to move FHA they didn't think about, and especially in the refinance area, I mean, where they can just really, really do a good job. Going from conventional to FHA is really advantageous in a lot of places, and it's not something that like a traditional loan officer is going to think about in a lot of cases. And let me just say one thing about rental income too, and rental payment rather. So like, you know, we've been in that positive rental history pilot with the agencies. Maybe I think it's just guide now, but for years, right? And we had one of the like highest numbers of qualifications that flipped to that. And I'll just say this, like, Fannie sat down and they were talking about this and wanted to like interview with what we're doing. It's just because we were linking a lot of asset statements, right? And as we look back at it, we're like, wow, that's crazy. Like, we're not really noticing this materially as feedback from our underwriting staff, et cetera. What is it? And then we saw like the numbers just weren't really all that impressive. Like yeah, we were in the top few lenders in the country, but like it was still so tight a guideline, right, that it wasn't really moving the needle to the degree that we wish. Like it wasn't thousands of people. Let's just put it that way, right? And when we looked at it, we're like, what do we got? Like 5,000 of these? Like this is great. Like let's put out a story. And we're like, ooh, hey, at least we were doing well. But I'm sure we'll continue to grow on that as well.
Well, Justin, you said the magic word AI. So we're going to take a quick break. And when we come back, Housing Insiders is an AI podcast from now. No, I'm just kidding. But we are going to ask you some questions. We do want to ask you about technology and customer satisfaction. So we're going to take a quick break, come right back. Today, we're talking to Justin Messer, the CEO of Prosperity Mortgage. And Justin, you mentioned the customer experience. You mentioned the customer expectations and how much they hear about what they can and can't afford and what they do. We noted that JD Power ranked you guys number one for customer satisfaction. And I was curious, like, what does that mean? What is the customer? What are you hearing that the customer expectations are? What do they want? How does technology play into that? I know I'm asking three questions at once, but I really want to understand, like, how did you approach it and how did that come to be?
It's tough to know exactly because there is variability in these things, right? We just do our absolute best and we're always striving to be number one, whether it be JD Power, experience.com, Google reviews, Zillow reviews, you name it, right? Because again, the customer experience reflects on the referral that the agent gave to us, right? So like we're trying to protect the brand together. I think, for our like the specificity of the data for Prosperity itself, the thing that we really, really, really seem to excel on is like trust. So in other words, a trusted advisor, and like over informative and over communicative. So we communicate frequently, we give valuable advice in the customer's opinion, right? And we are a trusted actor in the transaction. Now, those all to me seem like very, very, very table stakes things. But when you read deeper into like the depth of the surveys, you realize that a lot of people don't really trade in this. They trade in rate and getting it done, and they don't really care how it happens. And they fulfill a need in the market, right? We just don't necessarily fulfill that need specifically most of the time, right? Most of the time we're more on this like hands-on customer service angle. I'll tell you the one thing that the one funny thing that we kind of have tried to really improve on is this interesting weird combination of consumers said to us that we basically overpromised and underdelivered in terms of our closing turn times, and we were an outlier in that versus the marketplace. But we closed on average 4 days faster than everyone else in the survey. So like it was like our people want so desperately to please and so desperately to hit expectations that you bring in a non QM with 37K ones and RSUs, and they go 8 days, baby, we got this, right? We are going to save the day. Any agent that we know that has a problem, like we always get that loan to us, right? If something's happening, and then we try to save the day, et cetera. So it's interesting when you look at the vectors of this, Jeremy. I'm not doing a great job answering your question, but it's like even things that you don't think are going to hold you back, which is that is something you need to retrain your sales force on. That like again, it's the same thing of like, hey, bad news delivered quickly is the best possible way to deliver it. And secondly, like setting a realistic expectation is so more is has such a greater impact on the transaction than even if you slip by a day. Like slipping by a day is much worse than just saying it's going to happen 2 days later and then surprising one day to the other side, which again seems like common sense, but in the moment, I think it's really, really tough in that agent loan officer interaction to kind of always trip to kind of not necessarily worst case, but just slightly worse than you think your best outcome can be.
I mean, it's an incredible ranking. You've had the opportunity to work for great business cultures. I think with Rocket, the isms are very famous, and almost as you were saying a couple of those lines, I was thinking, boy, those sound like the prosperity isms. But now you're under another family of companies, at least that I've had the privilege of having worked closely with when I was at Fannie. In the Berkshire world, they've got a very sort of well-known approach. Patient capital, lower debt, sort of a long-term thinking mentality, and also just good adherence to metrics. I'm just kind of curious how that's kind of shaped your company, your thinking. Is that culture kind of flow through all the companies, or is that does that have especially I like the idea of this kind of long-term patient thinking that Berkshire tends to have. Anyway, just curious to get your thoughts on that.
Yeah, I mean, I think the one thing that you get from Berkshire is like you've never made a wrong decision if that decision avoided reputational risk. That's probably the most important thing. And reputational risk is a very broad way, right, of like, always operating with integrity, caring more about the right decision than what costs money, like never operating for short term gain in that sense. Like, that's not what we do here, right? We don't take these unnecessary risks that potentially could look good on a quarter or a year or anything like that. And slow and steady kind of wins the race. So, building a great reputation as a business. I think was one thing that when we became part of the Berkshire family, we understood we were fully aligned on, right? So that's really what it is. It's just a core of, and it's not necessarily risk avoidance. Like, I don't want to make it sound like that's what it is, right? But it's being very, very, very practical in what you're looking at, understanding the risks, and then generally presenting those up. For us, we're owned by Berkshire Hathaway Energy, so we're owned by a vertical of Berkshire Hathaway. So we report up to them, and kind of any big initiative we have, we kind of flow it through there and talk about it. And I'd say it's very risk and reputational centric in general. So that's the culture. A lot of empowerment, a lot of, if it makes sense, you know, they'll invest money in it and do it for the most part, as long as they don't, see any outside risks there. And very flat and accessible, I think, is something that's interesting. Like the new CEO, Greg Abel, he's been very involved in our business. He's very involved in our real estate business. And he gets into the details. Like, he's a brilliant person and a brilliant business operator that really, really digs in quickly. He's like, having a conversation with him is like a dreadful auditor. It's like if like an auditor who immediately knows all of your soft underbellies, right? And they're like, yeah, but like, what about pass through fee number 14 that was broken like 2 years ago and you forgot about it? And you're like, oh, yeah. So like, just a really, really brilliant person to work with, because you don't need to spend a lot of time setting foundations and backgrounds. Instead, you can get to the point about the strategic idea is, and then decisions are made fairly quickly after that.
That makes sense. Can you tell us, you mentioned we've talked a little bit today about like it's commodity, it's a captive to the agencies or captive to the secondary market investors. But you've also mentioned like big initiatives going up, big initiatives you've looked at. Can you talk a little bit about what those investments look like, what those big initiatives are? Like what's on your top of your mind that you say, fundamentally, these are the top three things that will drive our business going forward?
Well, I'll just talk about the biggest one we're working on, which is probably the most important. I'd say let's call it 2 years ago. If you couldn't read a Zillow quarterly report without seeing the super app, right? And their focus on unifying the experience. Naturally, you see Rocket, Cooper, Redfin together unifying the experience. And again, with a focus on what? Like convenience, simplicity, like delight is what I would say, like a delightful transaction. And if you're a Berkshire company, if you're us, Home Services of America, generally you're not viewed as a tech company. Like, it made news when they invested in Apple, who's not a tech company, right? And then it was like, but then Google, it's like, oh, a real tech company, right? So not exactly thought of as on the absolute frontier of tech, right? And I think in our industry, at least, in other industries, probably not so much, but Zillow and Rocket are certainly there, right? The complete change that we've seen in the world, right? Well, and I'll say this, like we are viewed inappropriately as more of a customer centric, relationship centric organization versus either of them, right? So like we're more the customer, old school sphere, love it or hate it. I'm not going to sit here and say, get off my lawn. This is always going to be this way and never going to change, right? But that's who we were, that's who they were. And I think the idea that a customer and relationship and sphere business could ever sprint towards having any type of tech parity, even remote parity, with that, or even a compass, was laughable 2 years ago. In the world today, it's quite different, right? You're able to sprint to something pretty dang close, not there, right, but pretty dang close to a customer and how a customer is going to feel very quickly. So we took a step back and we go, wait a minute, the really hard thing to do is build decades and decades of trust between the marketplace and you and realtors and loan officers and title and insurance and all of these disparate parts, and make them sing together with humans and relationships and local for people who want that. Oh, well, we can kind of choose to make an investment to build the tech. So we presented that up to Berkshire and they're like, no brainer. Like, let's do it. Right. So, we've been investing in that pretty significantly, over time to create, our version of and I hate to say a super app, because really it's just a single, it's the complete real estate experience is what we're calling it. Right. So it's a customer experience where, again, it feels knitted together, but with local humans behind it, or at least a few local humans behind it who are in the market and they can approach, right? Naturally fulfilled, centralized, and things like that. But our approach of putting the agent in the center of the transactions, the real estate professional in the center, right? And still using them as the centerpiece of the transaction, but then seamlessly integrating all of our other experiences into a single, like I said, delightful, convenient experience for the consumer. I think is really what our focus has been, and we started to deliver the first few iterations of that. But my hope is this time in 2027, it's going to be a very different experience for us. And again, it's just, what can you deliver to the marketplace that differentiates and creates something for the customer, and how do you turn something that, again, 2 years ago was probably in a lot of circles looked at as like a dinosaur strategy and something that was going to fade away, but could actually become a competitive advantage for us. And I think we are finding a great way to turn it into a huge competitive advantage for us, while giving people, choose whatever way you want to interact with us that you want.
I mean, I love that, and I think that's a very smart way to deploy tech. Is just, I mean, it's been a theme of this podcast that buying a home, you're working with 6, 7 different licensed professionals. It feels very disjointed. There's the sort of business relationship that needs to be solved for by sort of either consolidating or bringing them together, and then there's just the tech experience going in and out of different portals and applying for different things at different places. Every single one of them wants to know what your middle name is. It's just really frustrating. I want to go back to the magic word that Jeremy said, which we'll ask all of the various CEOs of mortgage lenders that we talk to, but AI. So what you mentioned, and I think sort of implicit in what you're saying, is like you can move very quickly with technology now because AI sort of is very much leveling the playing field. Is that sort of where you see the real advantages of AI kind of coming into play for you guys, or do you see other places where in your workflow, whether it's underwriting, processing, supporting loan officers, helping borrowers find the right home using a chat bot. Like, where do you see AI really kind of making a huge difference to you guys versus like where it might just be overhyped?
Yeah, we'll know soon, right? I mean, that's the thing. It's so fast. You almost don't want to do anything. You want to be like, I'm going to wait 2 weeks, and then I'm going to do it, and then I'm going to wait. So like, there's no time that you can go. You just have to go and iterate, right? For us, like the easiest internal uses have just been productivity boosters. So just using the actual structured data that we have, which we're a mortgage company, so like everybody, well, the majority, there's not a lot of it. There's not a lot of great versions of it, right? But things like policies, guidelines, et cetera, pricing, products, those types of things, being able to, I would say, like, level that up and not just put like a traditional RAG model on it, but something a little bit smarter than that, to really interact with folks, has been our biggest win. The next thing you see is like some light client interaction, right? Like, you don't want to completely upset the world, especially when you have agents in the transaction. If you start just layering in a ton of voice AI, I think it's a bad thing, at least in our opinion, right? But like some light texting, you got to deal with TCPA. You got to make sure you're locked in on that and that you're fully compliant. But some light incubation or touch bases through texting, I think, is a huge piece of AI that I think is going to be a natural next step for us in the journey. In terms of like the process, underwriting, et cetera, all things. I mean, the low, the immediate implementations of kind of dot classification and understanding and reading and naming correctly is an easy first step, right? When you go to the next steps, you start to get a little more complicated, in my opinion, and it's still like it's going to win out. I just don't know when, and I don't know what the right time is, which I think is what most people's consternation is around this, right? Like logically, it makes sense, right? The question is like you never want to be in a position where at least I don't ever want to be in a position, right, where I don't really understand something entirely. I don't understand how it can break or when it can break or what's going to go wrong because I don't know enough about it yet. And saying all of a sudden I've doubled in volume, let's say, and I haven't added any humans, right? And here I am, and then something goes wrong and I don't know what to do. Trying to acquire humans with that ability, that's the lizard brain part of me that I'm still struggling with a bit here, right? And I know we'll get across it, but I would imagine that that's like going to be a mildly common refrain from those people who aren't like out on the frontier and ready to go, right? So it's kind of limp in. I think, if you want to talk specifically about Prosperity's strategy, it would be to, give us, more elasticity in terms of scale, right? So to start with, it would be, hey, we can turn things on and off, more like almost like, like our traditional way to do this would be to add temps in very specific manufacturing roles, instead having those fulfilled agentically, right? That would be kind of step one to say maybe we can staff at like our winter levels, and see and ride the spring summer peak. That would be like our first stress test, right? And then we move forward. But really, like the interesting thing is, I really think this is going to be like a gradually then suddenly moment is the best way I can describe it. Like all of a sudden, if you don't have this like stress test and ready to go in your organization, at some point, once people start deploying this at scale, that's going to be that great like Warren Buffett like tide out moment, right? Where all of a sudden like everyone's going to have all kinds of options. You're going to have pricing power. You're going to have scalability. You're going to have everything at your disposal, and it's just going to be a new set of tactics. Like where are you going to decide to deploy this and do this? What are you going to decide to do with it? I mean, it makes acquisitions a very very interesting topic to say if I can scale like the synergies that I immediately get, if I don't really have to add a significant thing, but instead have a like fixed cost solution where my only variable is really token cost, I can start to think about that, especially if I have really, really good prompts written that, I know how expensive they're probably going to be. That's kind of where we see it and where we see it going. I'm sure people have a lot more novel and interesting thoughts than that, but I would say we certainly want to be in a position, and it's probably too late, but I'd say if in 18 months I'm looking down and I don't have, the ability to fully turn on a fully headless with a human, I wouldn't say fully headless, I'd say still human in the loop, obviously, but nearly headless transaction should I want to, and should I decide that that risk is worth it and that it's there, just to augment kind of what we can do in staffing, then you're probably behind. But
Mm.
it's probably sooner than that. But like, what can you run towards is the question, and how can you do it responsibly? And quite frankly, like I think most people don't have, their SOPs and their tasks in enough hygiene to be able to really do this appropriately. So, our approach has been to stop, tear down, and rebuild from the ground up in more consumable tasks in a concept and redesign that way, so that again we're ready. And I think I'm okay being 3 months late to the party. I think anybody who says I'm going to fast follow and when I see the world changing, I'm going to be 18 months away is probably too late.
Yep, I think that's smart.
I just have one quick follow up. You mentioned getting ready and having all that ready. There's always been this weird dynamic in the mortgage industry, which is so dependent on suppliers, vendors, service providers, right? I tried to map it once when I was at a startup and I got to like 73 different service providers and I gave up. I don't even know if there were more, but like I was trying to go from start to finish. How many does a mortgage lender need? Do you get a sense AI is best delivered through an existing partner or through your team understanding it and finding a way to do it?
So that's a tough question because it depends how much you care about governance. And as part of an entity that cares strongly about governance, the more and more you're reliant on something you don't control and you don't have line of sight into, at least now in an unknown kind of industry like this, it adds risk, and it adds again in their mind or in an AI governance mind, like it adds reputational risk, it adds compliance risk, it adds regulatory risk. So depending on vendors is a little bit less of something I would want to do in this space, and it's just tough. Like I don't know enough about this other than to think that, your core systems, your plumbing is probably going to still exist, like, and then the intelligence layer, the agentic layer on top is going to be what competes. And I think, that's going to be your secret sauce over time. And if you co-develop that with somebody who knows what they're doing, probably the best. So probably like a co-development strategy is what we are kind of looking at to deploy, which is utilize as much technical expertise we have from other folks and utilizing kind of our business intelligence and SMEs around writing core prompts, but then having, the kind of next layer of people really optimize them for efficiency and cost. I think is the approach that we're taking kind of over the top, because I think you'll be able to layer this on top of most all of your vendor systems, and then you don't have to necessarily opt into their solutions, although they may be great. If I'm a little less effective, so whatever that percentage of efficacy is, but I feel like I have good governance over the top of it, I think that's really important, at least for us.
As typical, I'm going to let Jeremy ask the last question, and I know we're coming up on a full hour here, and you've been generous with your time, Justin. And I know it's busy season in the mortgage space, but I'm just going to give you a shout out before I let Jeremy ask the last question, which is we noticed that you're working with Landy Lou, one of our previous guests at Foyer. I thought that was a very cool relationship, and wanted to just congratulate you on doing that. I think it's an interesting pipeline to start building, and as that company hopefully grows, I think that's a great sort of runway for you guys to take advantage of that.
Let's get some of that legislation passed, that tax-free money for down payment. That's like the most common sense thing I've ever thought of, and hopefully we get some good news on that in the near future, and Foyer's really positioned well to supercharge that for folks and make it a reality. Great program and great thing. Yeah.
Yeah, we have the 401k, we have the 529. Where is that same account for homeownership? So we're right with you. The last question we always like to ask, Justin, is actually a great segue from Foyer, because they're entrepreneurs and they've started working on something that is incredibly hard and valuable. So we like to ask CEOs like you, if you weren't doing what you're doing, what would you be inventing? What would you be working on? What do you wish existed that somebody should work on? So it's sort of this question of, if you had an audience with those innovators and entrepreneurs listening, what should they think about? But what do you wish existed that doesn't?
Well, it's becoming like, the weird thing is, I've this has been a core thought of mine for like a decade, and now it's existing. which is I mean, I think everything should be looked at. Like we talked about inventing something, and maybe it's already out there, but this was like a should we start our own spin-off in prosperity of something called task parency. And it was just about every single thing that's done in your organization is a task and it's scored. Okay, like from beginning to end. And now I'm like kicking myself because I'm like, man, if we would have done this, like like the agentic layer would have just taken it over. And it's one of those things that I'll just say like it's a regret of mine, because I look at it and I've like been beating this drum, and then all of a sudden, when you have that epiphany, whenever anyone has it, like for me it was over a year ago, that like that is what was going to drive the next generation of everything you do. And I look and I go, wow, I've been preaching this and I have no hygiene of this in my own organization. Like this is sad. Like I need to do that, right? So like a universal discipline of tasks in everything people do, from emails to Slack messages to Teams messages to calls, just a scoring of everything, I think is the thing that I would love to see introduced. And maybe it's already out there and I don't know about it. I'm sure it is, but that's it. Me personally, it's interesting. I think I'm so obsessed with our business and what the asteroid is and what's going to happen next, that I don't daydream nearly as much as I should. So let me just say that, and apologize up front that as a mortgage lifer, I know nothing outside of these four or three walls in a bar. So for me, my dream is just to do the best for my people and get as many people in houses as possible.
Well, Justin, if
Awesome.
you ever
Thank you.
do start task parency, please do not give it to my wife. I feel like there's some dangerous applications of that. Justin, so great to see you. Thank you so much for spending time with us.
Hey guys, thank you so much. I appreciate it.
Thanks, Justin.
Yeah, so that'll do it for today's episode. Just a reminder to everybody that July is Mortgage Month, and what that means is you'll soon see Hallmark cards at your local Hallmark dealership that will have messages for your local loan officer or CEO of your local IMB. So be sure to give them a hug this month and hope that rates go down 2% so that we can all be doing a whole lot more business. You guys know where to find us, but please, like as we always ask, subscribe to our podcast and the various different channels, leave comments. And if you have questions or any comments on today's episode or other episodes, you can always email us at podcast@thehousinginsiders.com.
Share this episode. If you know somebody who should be a guest or who should sponsor Housing Insiders, please reach out to us. And thank you, as always, to Keenan Chen for our music.